All right. We are live on our show today, Dfi-nancial Friday. Working off a little bit of a different technology today, so hopefully you guys are still seeing us okay. But we've got a fantastic show for you guys today. We're going to be talking a bit about probably what I would consider our most popular topic, especially in the past year, and we'll discuss why in just a second. But IPOs, we're going to be talking about IPOs, talking about as employees, right? That's the focus. How do you best prepare for something like this and not get caught off guard? How to maximize what you've worked hard for, right? All of that is going to be our main focus. Okay, but again, this is Dfi-nancial Friday. My name is Alfred from DiversiFi Capital, and of course we've got the OG. We've got the CEO of the company. We've got Nathan Dingler joining us today. Nathan, how are you doing?
Good, man. Happy Friday. Good to be here.
Happy Friday. That's what Raymond always says. I always tell him,
Yeah.
Raymond, it's Friday, how excited we are to be here. But we've got a really fun show. I think
Yeah.
it's something that I mean, I would say if you asked me today, right, what was our most popular client topic last year and the type of client we got, I mean, it was a lot of people trying to understand what their equity compensation meant to them as their company was going towards being public, right? And I think from that perspective, it's a confusing one because one, the numbers are so big and it's, they want to get it right, but I don't know that the company, Nate, right, provides as much information, right, to the employees as maybe they even want to. I think maybe it's a
hmm
liability thing.
Definitely.
Uh, but I mean, how many times have you seen a client come in with maybe a pretty sizable amount of company worth, let's call it, because in a variety of different ways, but doesn't
hmm
have much idea of what it actually means when their company's going public.
Yeah. I mean, it's sadly very, very common. You might get like a big bank coming in to pitch to them. But a lot of times it's like very salesy. They're not giving, the exact advice that their, investment client or I guess, employee needs to act on their own personal decisions. So
Yeah.
yeah, that's why we're here.
So the topic itself today is, by the way, this is something we covered about a year ago, and it's probably one of our most watched videos on our channel since then, and probably again for all the reasons that we listed, but some I think goes to show how crazy this IPO market was in 2020 and 2021. So Nate, give us some statistic. Like I was shocked by this, I think, when
Yeah.
I like read up on it because we felt the client volume, but then you look at the actual data and it was
Right.
wild.
Yeah, crazy. So 2019, right, pre-pandemic, we thought the IPO market was pretty hot then. 232 IPOs took place in 2019. Fast forward to 2020, and that number doubled. We're at 480 in 2020 during a pandemic, right? And fast forward to 2021, and we're already past 2020's figure, having completed 483 IPOs just through what, halfway through May, 4.5 months of work done so far. I mean, if you
Yeah.
think about it, there's also been just shy of about 5,200 IPOs since the year 2000. So we're talking like almost 10% of them in the last 20 plus years completed just this year. Like that's how
Yeah.
crazy the IPO market is right now.
And it drives. I mean, if you guys have been watching our show, you know that Raymond and I have been talking about like why the housing market's crazy, why the stock market feels crazy. I mean, so much of it was in this IPO market, right? That caused and created so much capital. But the focus today is a little different, right? It's about you and understanding how am I going to deal with this? Like, what should I be thinking about, right? And
Right.
so Nathan and I are going to cover three periods in what we walk our clients through in thinking about your company. We call it liquidity event for now because we're going to describe why we say that, since liquidity event can come in a form of an IPO or a couple of different manners, right? But what to think about before this liquidity event, what to think about during one, and then what to think about after, right, it actually happens, right? And if you can grasp some of this, or at least ask the questions in the right way, I think you'll feel a lot more comfortable with hopefully what is a lot of new wealth, right? That you get to be part of, right? That you've worked hard for and now are seeing, right? The benefit of it. Okay. So before we get started, just remember that anything we talk about, especially today, right, is not meant to be personalized financial planning. There's a place for that. DiversiFiCapital.com. Head to the Get Started page. We've got a video of myself talking about why, right? We're trying to change the industry for the better, and hopefully that is giving you the ability to get education at a cost that is affordable, right, to everybody. We're also going to talk about some tax implications, right? But know that, right, Nathan and I are not acting as your tax professional here, okay? We're going to be talking about taxes from an education standpoint, and hopefully something that you can bring to your tax professional and ask the right questions. That's always what we're trying to do, is have you guys start asking the right questions, all right? So you're an employee at one of these tech firms, biotech firms, whatever you want to call it, right? And you've got company equity, right? And so as we get into this, you're an employee before this event is even happening, but it might be announced and you're thinking to yourself, what does this actually mean to me? So first, can you, Nathan, tell us a little bit about the differences about what the company might tell their employees of how they're going public, right? Like, what are the different ways, and what's been the newest way that we've seen in this 2021 edition of our IPO webinar?
Yeah. So when we talked about this, September of last year, it was traditional IPO route, which means company is raising money by selling some of their stock to the public market so that it can be publicly traded. And that's what everyone's familiar with, right? You're going to have a JP Morgan, a Goldman Sachs, one of those type of companies help raise money, go through the roadshow, attract investors, and bring the company to the public market. When you get something like that, a lot of times those big banks are going to want to limit the volatility because they're also taking some participation in the IPO. And so they want to make sure that their shares are continuing to be worth something substantial. So that's where you see lockup on insiders happen. So 6-month lockups, meaning like if you're an employee, you can't actually sell on the day of IPO. You have to wait 6 months before you can sell. So we've got traditional IPO. We've got direct listing. Direct listing has become more and more popular. We saw it with Palantir. We saw it with Slack. We've seen it with Spotify prior to Palantir. And this is where a company is saying, hey, we're just going to be publicly traded, but we're not raising money. We actually have enough cash on the books. We don't need to raise money. Maybe they already did a fundraising round just prior to the IPO. In the case of Palantir, maybe they're just doing it because they've been private for so long. I think in that case, it was like a 17-year, span where they were private. Just a lot of pressure from other investors to say like, hey, let's do something here.
Yep.
And so direct listing is it's got its own nuances. You may run into company required lockup windows. That doesn't mean that a JP Morgan or Goldman Sachs is doing that because they're not participating, they're not charging a fee, they're not taking a stake in the company because they're not doing the traditional IPO. It's just company is directing the listing opportunity, and you may or may not have immediate trading restrictions. I think maybe in the case of Slack, there wasn't any restrictions. In the case of Palantir, there was. So it's really company by company. But the key difference is direct listing doesn't cost the company nearly as much as a traditional IPO because they're not raising any money. Another way has been not to list at all. I mean, there's been acquisitions that can take place, even if you already filed your S1, meaning an S1 is like, hey, we're indicating that we're planning to go public. Companies can still get acquired after that S1 has been filed. I think, again, when we did our September webinar, we were referencing Postmates that got acquired instead of going public. And we can talk through what that is, but that's another way for a liquidity event to happen because now you're bought out by another company and you might have some conversion or a cash out of your shares.
Yeah.
And the latest, more popular way recently is through a SPAC, right? So special purpose acquisition company, basically a blank check company. So what happens here is the SPAC company will be listed as a stock before they've even identified the company that they're helping to go public. And a lot of times you're going to see like some celebrity or some really well-known investor be like the face of the fund. It's like, hey, I think even Shaquille O'Neal has a SPAC. And so people are like, oh, I trust this guy. He's going to be able to attract the right company. So I'm going to invest in this blank check company, hoping that they help bring a really good company to the public market. Now, with the SPAC, there's a lot of nuances to it, but basically, that SPAC has a 2-year window to identify a company to bring to the public market. They're then taking that blank check, or basically taking the investment money that they were able to raise and buying a share of the company that they're bringing to the public market. And those are the shares that will then be made public for trading going forward. Now, once that company is publicly traded, the company can always, issue more shares in a secondary offering, something like that. But initially, it's just SPAC buying shares and then listing them on the public market. If you're investing in this SPAC as an investor, so not talking about the employees, you have the opportunity to say, no, I don't want this company. You can redeem your shares out. Again, there's some nuance to that, but there is an opportunity to do that. But as an employee, we're specifically speaking to employees here, a SPAC may actually seem very similar to a traditional IPO and a
Right.
direct listing. All three of them can actually play out the exact same way for you as an employee. You may still have restrictions on how soon you can sell. Could be 6 months, could be 12 months, could be none. Again, it's just how the company is bringing those shares to the public market. So traditional is they're raising money, they're getting capital for that, and JP Morgan, Goldman Sachs is helping them do that. So there's a fee associated.
Yeah.
Direct listing, they're not raising any money. There's very little, well, there's some fee, but very little fee compared to traditional list. In SPAC, they're selling some of their shares to a holding company that is bringing those shares to the public market.
Yeah.
But again, they're all an IPO event and they're all a liquidity event for you as an employee.
Right. Because right before this, right, you know, before any company going public, you might hold these shares, you might hold these options, and there probably, you know, wasn't much you could do with them from actually cashing out. Now there are secondary markets we talk about, and so I think that in general causes people to think, I don't need to do anything with them, right, before I go IPO. And I think that's where we come up with, in most cases, a lot of the strategy to talk about is like, how do you actually plan beforehand? So now that Nate's talked about, right, all the different ways that you can go public, right, some things that you have to think about is that, right, as you're headed into these IPOs, especially with your options, look, right, there's blackout windows, okay? And so we talk about the idea where you can't just expect to take your options and exercise them and sell them right away because you're not allowed to, right? And so the one thing that you guys should all check, right, if you guys have stock options is A, when is my expiration for some of these options, right? Now, in some cases, if your company hasn't been around for that long, might not be an issue. A lot of expiration like windows for options are about 10 years from when they're initially granted, so that may not be a problem. But if you have been at the company for 9 years and you're finally like, yes, you know, my company is going public, you might still be in trouble because of that lockup window. Okay, we ran into some of those situations, so you need to think ahead about, you know, if I don't have the money to exercise the shares and pay taxes on these options, and I am expiring, right? There are ways that you need to get funding to make sure that you don't lose out on what is potentially a tremendous value, right? And so it kind of leads us into this second question, Nate, which is, if I'm thinking about before the liquidity event, should I be exercising more options before? And again, what if I have expiring options, right? So I've talked a little bit about the expiring side, but maybe you can tell me about, right, like, what are some of the benefits of exercising your shares right before the liquidity event? And in general,
Mhm.
like, how does that work?
Yeah, I mean, I think before we hop into that, we got to explain the difference between the two types of options you might have, right?
That's right.
So, chances are you probably have ISOs if you're, in a privately held company, but oftentimes you may run into NSO, so incentive stock options or non-qualified stock options. So, pretty big tax difference between the two. So, in the case of ISOs, um, in the case of all options, you're going to have a strike price. Your strike price is simply how much does it cost you to take possession of your shares. So maybe it's $1 strike and you have 10,000 options. And so therefore it's going to cost you $10,000 to take possession of your shares. But when you act on those options, meaning you're taking possession of them, you're going to potentially create a tax liability because you may not be exercising when it's $1 fair market value, right? Maybe you're exercising now when it's a $10 fair market value. So now you have some embedded gain there, right? A $9 embedded gain per share. And this is where it differs, right? In the case of an ISO, you can exercise, pay the $10,000 in the example I gave. But now that $9 per share times 10,000 shares, you're going to have a $90,000 AMT item that you have to add to your taxes. And so you're going to have to pay that AMT tax to the IRS. And in some cases, states also have AMT tax. And this is going to allow you, assuming that you hold those shares for at least 1 year and a day, allow you to retroactively claim long-term capital gains all the way back to that original $1 strike. So the ISOs are obviously, the better of the two, because you can retroactively claim that long-term capital gain. Going forward, you would then also be able to claim that AMT payment as a credit in your future tax years. Again, there's some nuances. You got to check with your CPA or accountant on how that would work for you specifically. But the whole idea is, hey, you can pay this AMT cost up front so that you can claim long-term capital gains when you sell the shares later. Not the case with NSOs. NSOs, that same example I just gave, that $10 to $1 strike, you're always going to pay ordinary taxes on that difference. And so usually if you have NSOs, you can see it's generally better to try, if you can, assuming you have the cash to do so and you're willing to take that opportunity cost to do so, try to exercise your NSOs as quickly as you can, because you're always going to pay ordinary income on that gain until you exercise. But let's say you exercised at $10. Sure, you paid ordinary income on $1 to $10, but let's say you eventually sold those shares at $100. That's where you get that long-term capital gain tax treatment, is anything forward from that $10 fair market value at exercise can qualify for long-term capital gain. So if you're in a position to exercise when it was $1 fair market value, you can see there's a lot of advantage to the NSO. ISOs act the same way, by the way. It's not like NSOs are different. Like going forward, everything can be long-term capital gains because that's when you're taking possession of the shares.
Yep.
But the difference is prior to exercise, how that tax is different.
Yeah. And look, does that sound confusing? Absolutely, right? This is something that, like, we understand that. We talked about this with Raymond, like this. We had a show about it to go through some of the basics of like stock option and IPOs. This is a little bit more of a deeper dive. And again, it's to give back to the community to hopefully understand that there's a lot of nuances to understand about the options, right? Like what Nathan's talking about is just the definitions of what is an ISO and what is an NSO. But there's a further part to that. Is like, does it make sense for you individually to spend the money right now, whether it's your financial goals, right? What do you have outstanding? Are you going to try to buy a house? Does it make sense for you to put that into the company? Because it does take time. Potentially, if you put it into company, generally you have to want to wait a year before you do anything else with it to get that long-term capital gain before you sell off. And in that year, a lot can happen, right? Like we have to talk about with our clients, like what if the stock price goes way down, right? What if I wanted to sell on day one, right? Like, while tax efficiency might be there, you also have to weigh the risk of what we've already seen in the past 6 months, which is all of these IPOs that you talked about, Nate, that went public in 2020, hit highs in December, January, February, and have a lot of them have just come crashing down, right? Totally. And so you have to remember that it is ultimately still an investment, right? Like what I mean by that is like the money that you're taking, right, to go and buy the option, pay the tax on the option, while you might get some of that back at a more favorable rate, you are still investing all of that money into the company. So to simplify for the audience a little bit, I always ask the question of, all right, while it makes sense from a tax perspective, maybe sometimes it makes a lot of sense. Are you willing to invest X dollars that we're talking about into the company right now? The client said, yeah, absolutely. Great. Let's do it. Or they might say, wow, that's a lot of money to invest in one company. I said, okay, then maybe we need to back off on what might be some tax savings there, right? And so it's that grounding the decision to what is the actual purpose of this investment. And ultimately, yes, it could save us taxes, but it is still an investment decision that the stock could be half the price or 80% less value down the line, right? So we can't always just bank on that to go up, right? And so to summarize again, right, with ISOs, when you exercise, what happens is you're basically paying some tax up front that you might be able to get back, right? That's why it's this called this alternative minimum tax. Like, again, it's a terminology that comes up, confuses people, right? Just think of it as a different calculation than your regular taxes. And they don't add it to your regular taxes like the non-qualified stock option, because once it's added to your regular tax, you can't change it, right? Like it's there, it's ordinary income. So they add it to your AMT. And then, because there's 5 different ways how ISOs can be changed or treated for tax purposes, it allows them to say, okay, down the line, we now know what you did with the shares. Let's get some money back that you paid up front. So it's kind of like a placeholder per se, right? A placeholder allowing you to get that gain all the way back to maybe what is a very low strike price, right? And so, right, to think through that, like, and summarize that, if a client is thinking about exercising more, Nate, right? Like if they're thinking about exercising more shares, right? It's, to me, right, because they're willing to invest in the company, right, after the dollar value, and, right, they're willing to hold for some time to get the taxes. Is there anything more that you think would be a good reason to exercise early?
I think that's a pretty good summary. I think usually if you are in a company that's planning on going IPO, even though it may or may not be public knowledge, you'll get some rumors going on at the water
Mm-hmm.
cooler, right?
Yeah,
So
yeah, yeah.
you have some inkling that something's brewing for a potential IPO. So you might have a little more confidence to exercise once you start hearing some of those rumors, because you have a little more clarity on what it would mean to hold for 1 year,
Yep.
right? Because strong chances are that you will probably go through a traditional IPO. Maybe you'll go through a SPAC, but even SPACs, for the most part, you're going to see a 6-month lockup, right? So if you start to see some rumors, maybe you feel comfortable exercising. Once you exercise, maybe it's still a few more months before the company goes public, then you also going to be subject to 6-month lockup anyways. Might help you with that 1 year time period. Still doesn't mean that it's the safest decision. Obviously, in that 6-month lockup, the stock itself is trading, even
Mm-hmm.
though you can't trade it. It is traded on the public market. So there's still obviously plenty of risk there. But knowing that you're going to be locked up anyways might help with that, getting over that 1 year hurdle.
Yeah. All right. And if you are in a situation, maybe you thought about now the timing, you're like, oh, Alfred, Nate, you're right. I have this 6-month lockup. I have options that are expiring and I can't, right? Like maybe get rid of them before
Mhm.
they're actually available to trade. One, you should ask your company, what does this mean for me? Like go up to them and ask them, like, can you extend these? Is there anything that you can do? Maybe it's a company imposed expiration, right? But if you're running up again, what we call the 10-year expiration, honestly, at that point, right, you should reach out to a professional. And because we're really talking about potentially you losing out on these options if it's significant value to have to pay
Right.
that upfront cost. You don't have the money. Like this is one of the first companies you've worked for and you've been there for 7, 8, 9 years and you don't have anything substantial yet, right? Then you need to figure out what the secondary market, right? Selling them before they go IPO or getting a loan, right? What is the cost of a loan? Does that make sense for me,
Mhm.
right? Those are then the questions you need to start
Right.
asking before, not during, right? The
Right.
liquidity event.
I mean,
Yeah.
fortunately, there's a lot of options in that space, right? If you're talking secondary market, we're not paid by these companies, so we're not advertising them,
Nope.
but SharesPost, EquityZen, Forge are popular secondary market transaction
Yep.
makers. Again, just helping buyers connect with you as a seller. If you're looking for the loans, then we've got SecFi, EquityB, uh,
Sure.
Quid is,
Quid. Yeah. Yeah. Yeah.
yeah.
Yeah. Yeah.
So there's a lot of options in that space too. And
Absolutely.
you just have to really shop between them. I mean, even though Shares Posts, and Equity Zen are both secondary market makers, they're finding different buyers. So they might have different prices for you. Even though Equity B and Quid are offering loans, they're at different terms. So you got to shop between all those different people and find the right solution for you. For some people, a loan might make the most sense. For some people, selling it outright might make the most sense. But just know there are plenty of options out there.
Yeah. So to close out the first piece of it, right, which is what to think about beforehand, you have to think about your options. Do I exercise early? What the cost is? Is it a good investment, right? And ultimately, right, making sure that you're getting ready, right, in my mind, for what is a big potential wealth change, right? And in that case, you just need to say, all right, like, this is something I don't want to lose, so I need to plan properly for, right? Now, as we're getting into, and maybe one more thing, which is I think most people confuse the options as the price I need to pay is just the exercise price that shows, right, on whatever platform it is, but they don't account for the tax costs. And that's a very, very big piece of it, which makes a lot of people get to a point where they're uncomfortable or don't have the cash to exercise, right? So you have to always think about, especially if there's gain, the cost of the exercise is the cost of the shares plus the taxes. Okay, so all right, as we're heading into during the liquidity event, I think a lot of timing around taxes come to play. Like, for example, like I have questions about, okay, I own these shares, I've never paid taxes on them, right? Like, what happens? So what's the biggest surprise that you've seen clients had, especially with something like, we've talked about options already so far and we've talked about the taxes, but like something, maybe it was shares, or we call them in some cases RSUs, right? Like where these are stock units that haven't turned into shares yet, but were granted to them. Tell us a little bit about what someone should expect during this event from a tax liability perspective.
Yeah. So we've covered options pretty well. Options, again, just to reiterate, you do not have a tax liability with options until you exercise. So whether it's private, whether it goes IPO, whether you're subject to lockout or not, you get to choose when you incur the tax, and that's when you exercise the options. RSUs are very different. RSUs are compensation paid to you in the form of stock. You can almost think of it as bonus payments, but instead of paying you in cash, they pay you in stock.
Yep.
But it's a little bit different with private RSUs, right? So the IRS has two different factors that have to be met in order for it to be considered compensation. One of them, obviously, is vesting. Okay, so yeah, you can vest during your, private days as a company. The second one is liquidity, right? So as a privately held company, it's not liquid yet, so therefore it's not taxable yet. But as soon as that IPO event happens, the day the IPO happens, it is liquid. Regardless if you having 6-month lockup or not, it is generally still considered a liquidity event and therefore taxable. And therefore, what usually happens is you will have tax withholding. How that tax withholding is, they don't send notice to you and say, hey, Mr. or Miss, pay me tax. No. They take shares from you to pay withholding on those RSUs. And so generally, as a default, in the IRS's case, you will see 22% of your shares not disappear, but be sold and go to the IRS for tax withholding. You may also have state withholding completed in the same way, as well as Social Security, Medicare. In California here, a lot of times we see a ratio of 40% of shares being sold and going to the various tax authorities. Keep in mind, it's an estimate. It has nothing to do with your actual tax rates. They are not going through every single employee and saying, oh, your tax rate is this, so we're going to do this. Oh, your tax rate is this, so we're going to do this. No. Everyone is withholding at the same rate. Then you have to go and do, with our clients, we'll do an estimated tax calculation with you live time to see, what your tax bill might look like. In some more unprepared individuals, you may not find out what your tax bill is until tax time. And not only do you have a big tax bill because you probably have a higher rate than 22%, you might also have an underpayment penalty to go along with it. So that can be a big surprise for a lot of people. But RSUs, as soon as they become liquid, are a taxable event, regardless of you selling or not.
Yeah, and I think that is the biggest surprise. Now, we've learned a little bit in 2021 as so many companies have gone public, right, with RSUs, and the basics are the same, right, which is, whether you've been at a company for 2 years or 4 years or 10 years, whatever it is, maybe, I mean, okay, maybe not that long because there's some limits of a 5-year limit, like how long they defer taxes for. But these RSUs, if I've been there for 3 years, Nate, right, all of it hits in 1 year, right? That's 3 years worth of basically income that I haven't paid taxes on, nor was it really income before that. It was kind of just, I mean, clients talk about it all the time. It's paper money, right? But like, it's real on that day. And you're like, whoa, like all of a sudden my income just went drastically higher. And so not only do I see that clients are surprised by how much tax they owe on the shares, I think they're also surprised by, because their general taxes has gone up, maybe their withholding on their normal income isn't enough now, right? Because they're just like substantially higher in terms of average tax rate, right, that they're paying across all of their income, right? But you know what I learned? I learned that some companies are realizing now that, hey, like maybe day one price of the stock isn't what I want to base it on, okay?
Right.
And so we're seeing more and more now where they're actually saying, okay, the tax isn't due on this until 3 months later or 6 months later, or at least they have the option to choose what that looks like. And we've seen these in the past where, a company like Uber had a chance to choose and then they decided not to. They just taxed everybody on the first day. And then 6 months later, the price was half the cost and it became a big issue, right? But there is that kind of piece there, which is like, what price? Okay, we're going to call it reference price for today, but what price is the company referencing here as the price that they're going to use to tax your shares on, right? Is it going to be something where it's today when it goes public? Is it right in 3 months? Is it in 6 months? You should definitely understand that to use and understand, I had 50,000 shares at now maybe potentially $25. That's my number that I need to account for, right? And so that's something that I think is a little different than maybe in our 2020 webinar where we talked about like, hey, like on day one, it's going to be taxed. We're seeing companies be a little bit more, I wouldn't say lenient, but I think understandable that it should be across maybe some small time frame, right, that they determine.
It's a really hard decision for the company too, right?
Yeah.
Because you don't know what is, I mean, ideally you want the lowest price to be the reference point. Is the lowest price the IPO price? Is it 3 months later? Is it 6 months later? So that's where Uber kind of got into some problems because their IPO price was so high. But personally, my opinion is it should be that 6 month mark because you can't actually sell it until you get that 6 month mark anyways.
True.
But I think ideally 6 months later you're at a higher price, and so for taxes it might be better to be the IPO, but who knows?
Maybe the
so for me,
company equity team should be. Maybe the company equity teams should be consulting with you, right? And getting a sense of. But yes, right. I think to summarize the during process is, one, sit back and get ready for the ride, okay? Because it's gonna be exciting, okay? But if you've hopefully prepared enough going into this, you understand what equity that you have already, what is going to be taxed at your choice, meaning options, and you can select when you exercise. What is not to your choice, which is the RSUs, and understanding that as it goes public, what price they're using, so you can go back and determine like what the tax is going to look like. And that's important because you need to figure out, if you don't have the cash on hand, how many shares you need to sell after the fact, right? So we're going to get into that in 1 second, right? But that's what we want to summarize there, right? Which is make sure you know, right, what you have on hand, what the tax liabilities are going to look like, and is it going to be enough or not? Spoiler alert, probably not, right? So, right, and cool. This leads us to the third part, right, which is we've talked about before, we've talked about during, here is now the after, right? Here's where you're either, in most cases, still really excited about what happened, right? And now realizing, my goodness, right, I've never had this type of money before. Now I have it, and I don't know how to think about it. And I think that's probably this feeling that a lot of our clients have, is like they just haven't seen this concentration in one company before as part of what is considered their net worth, right? Their assets, right? And so we're going to talk a bit about, right, some of the mentality aspect to it. And, maybe I'm going a little bit out of order, but like there is articles out there, right, Nate? Like in terms of like Wealthfront, tell us a little bit about like statistically speaking first, if I'm worried about my company shares after I've gone public, forget about all the tax implications for 1 second. Like, what do the studies say? What does our study, right, that we've done say about what you should do with the shares?
Yeah, I think the studies really focus on trying to minimize your regret factor, right?
Mm,
So regret meaning like, oh, I could have sold, I could have made a million, but company just didn't perform. And there's so much volatility that can take place with initial public offerings because we're just now, for the first time, seeing financials. And those financials can vary quite a bit in the first year, 2 years. I mean, Facebook didn't even know how to monetize when they went public. So you saw them go at $38 to $19, but now they're $300 because obviously they learned how to monetize. So there's so much volatility that can take place with IPOs that Wealthfront study and our study kind of confirmed this, that the best way to at least minimize that regret factor is to sell as much as you can as quickly as you can. Wealthfront says you should sell all of it right away. I think we're more of the mindset you should sell probably closer to at least 25 to 50% and then dollar cost average your way out for the rest, maybe over like a 12-month time period. But again, we're kind of close in our thinking is that you probably want to diversify as quickly as possible, especially if you're still an employee. I think a lot of people forget like their unvested stuff will still be worth more and more and more if the company does well. And so assuming you stay at the company, those shares will be yours eventually. So it's not like you're not participating if you sell your shares right away. Obviously, the key here being you have to reinvest your money. If you're
mm-hmm.
talking about selling and going to cash, like no,
No.
that's not a question.
Yeah.
We have to make sure that we're reinvesting that money.
Yeah.
Um,
And
but yeah, I mean, for every example of Google and Facebook and all the companies that have been super successful, there's plenty of examples of ones that weren't
I
and have
mean,
still to this day below their IPO price.
you still have to think about like it takes time, right? Like Tesla, right, wasn't always at this price. Facebook, right? People were wondering, like, is this company gonna, survive with not knowing how to monetize ads, right? All of those things, like they were, again, half their IPO price, right? And
Right.
so, it is a hard blanket statement to give in a show like this because it is so individualized about what someone should do. Now, you and I
Mhm.
and the team have a very solid thinking that, like, of course, like you need to spread out where the wealth is and make calculated risks. But more importantly, I think being very aware of your risk. Like if we talk about selling a certain amount of shares and clients like, I am so bullish on the company, I think it's going to go to the moon. Great. Like I fingers crossed it does go to the moon, but realize, right, what it means if it doesn't, right? And I think that's the main thing is like, if you have a situation where you're just hoping, right, that it goes somewhere, but it doesn't actually pan out and now you're struggling, that's not a good situation to be in, right? And so,
All those diamond hands on Wall Street bets are clowning about how they have so many losses recently on Reddit. So
yeah, yeah. I mean,
things are good when they're good, but they're bad when they're bad. So
well, people don't talk about it when it's bad, Nate, right? Like
exactly.
you don't have as many people posting,
Diversification always wins.
right?
So
Yeah. And so now, and if you do hold, okay, if you do decide to hold, that's okay. But make sure you don't panic, right? Give yourself time horizon, right? Give yourself, expect that anything that you hold on to is a 3, 4, 5 year thing to let it play out. That you're not worried about the fact that, again, as we've seen with most stocks in this past 6 months, fallen 30, 40%. What I say is, guess what? We've held on. The game plan was to hold on. The game plan was to give it time, and that doesn't change, right? But you do have to focus if you are thinking about liquidating. So we're going to talk about like, one question is like, okay, I am trying to sell. Which one should I sell first? What's the most efficient ones? But like, think about what we should be selling for first, right? So in my mind, right, the things that you should be selling for would be, again, diversification, like taking some off the table for maybe near-term goals that you have, right? And those near-term goals would be like, maybe I want to finally buy a house. I've been waiting for something like this, right? I have other financial goals I want to accomplish. But there's a key one there that might not be your goal, but certainly is a short-term goal, which is tying back to the middle piece, understanding your tax liability, right? Because you definitely want to make sure you're selling enough shares to cover for your tax. I would not want you to be in a situation where all of a sudden you need to come out with that money somewhere when you owe a really, really, really big tax bill, right? That's a lot of our main focus, is making sure clients have a very good understanding of that, okay? As we go into the selling though, maybe talk a little bit about an order of importance, right? Of like maybe what are the most efficient ones to sell, what are the least efficient ones to sell if you're trying to sell shares.
Yeah, I mean, kind of piggybacking on the explanation of options earlier, the whole reason we were talking about exercising is for the sake of trying to get long term capital gains. And so obviously we have to set a baseline. Do we think your company stock is going to go up, or do we think your company stock is going to go down? Okay, so let's start with the first one. If we think the company stock is going to go up, we want to hold the most tax efficient shares and sell those last. What
Mm-hmm.
that means is we're selling the least tax efficient shares or options first. And so the way that we think about it is, okay, we already told you NSOs are the least efficient options because you're always paying ordinary income on those. So those are obviously the first to go, right? You're not going to get any long-term capital gains on what has already been a gain. It's only going forward. So if we're selling something, let's unwind the NSOs first.
And those are
Second,
unexercised NSOs, right? We're talking about.
correct.
Mm-hmm.
Yep. Yep. So in this case, we'll refer to exercised options, whether it's NSOs or ISOs, as just shares.
Yep.
They get converted to shares. Second would be ISOs that you have not exercised yet. Maybe because of your cash position, you just don't have the ability to exercise and hold those ISOs. And so those unfortunately will be the next to go because we're just not going to be able to take advantage of the ISO benefit that exists there. And so
Mm-hmm.
what you have left is really just shares, right?
Yep.
They may have come from options that you've exercised. They could have come from RSUs that have vested, but they're shares. Okay. And so we would then sell, might sound weird, but I'll explain. We would then sell long-term capital gains first, with the thinking that the short-term capital gain shares that you have in hand will continue to be held so that they reach long-term capital gains. And so within long-term capital gains, you might have some at different price points. Price points meaning cost basis. Your cost basis might be different. Therefore, the tax on each lot might be different. And so the thinking is, assuming we have no other cash on hand, we want to be able to minimize your tax cost to allow for more shares to continue to be held. Therefore, you'd want to sell from highest cost basis long-term capital gains first, so you're minimizing your tax, then sell down to your lowest cost basis. Because again, lowest cost basis is going to generate the biggest tax bill. That tax bill is going to eat away at what money you have on hand. Therefore, it's going to require more shares to be sold if we don't have any other money on hand. So unexercised NSOs, unexercised ISOs, highest cost basis long-term shares, lowest cost basis long-term shares. The only reason short-term is last is we're assuming you would then hold them to achieve long-term capital gains, and then those would fall into the same order of operations.
Right. And don't forget, right? Like we also have to add to that maybe shares that you just vested, right? Like in that we talked about for the RSUs that just came due and you just paid a ton of taxes on those. This is also a common confusion, right? Like we just talked about the options, but with the RSUs, if I've just paid taxes on those and I'm sitting with the remainder shares, if I decided to sell those, right, it's all based off of whatever that most recent price that you paid tax on, right? So if it was $50 that you paid tax on and the price is still sitting at 50, you don't have any additional tax when selling those RSU shares that, right, just came due as well. So that's part of the equation, right? Now, it could be the case where, right, it vested and on day one, 6 months later, it's already above 50%, right, where it was vested. Yeah, like Nathan said, don't sell those shares because hopefully, right, if we have other shares to sell, in 6 more months, that 50% gain would become long-term, right? So that's a little bit more nuanced, right? Where we have to think about not just saying, hey, you know what, sell just your vested shares immediately, because generally when you're going IPO, there's this delay of time frame when you can actually sell, so the price change can be more dramatic. Now, as an ongoing situation that we talk about, or how to deal with future equity that you get, that might be different, right? In terms of how RSUs are treated, how do we think about that? Is it more just like a cash bonus, pretty much, right? That comes in form of stock, right? Because that's what it is, right? It's essentially shares that you get. They give you shares, but if you can think about it as, oh, you know what? That's $20,000, right? Did I want to buy more shares with that like bonus that had come in? If not, you probably shouldn't keep those RSUs, right? And so it's all about the mentality as you go forward when your company is public, because your compensation now will be tied to a big part of your stock, right? Prices. Okay. So I think that's a really, really good way to just position like how the shares, efficiency wise should be thought of, right? And again, prioritizing why you're selling the shares, for what reason, and then being okay with the fact that, you know what, after you sell, the price could go up or down from there. Like, that's all right. Like, there's so many things that could happen. You just need to make sure that when at the time you're selling, you're very aware of the pros and cons, right? Okay. So, all right. I think we've covered a lot of the aspect of mentality, right? Which we talked about in the studies. We've covered a little bit about the efficiency. Okay. There is one thing that I wanted to cover, right? Which is this idea around moving states and what it means in terms of taxation, because that has probably been one of our top questions after, like, especially in this pandemic year. Hopefully we're not in the pandemic year now, right? Hopefully we're slowly getting past that. But like the idea of state taxes, I'm sure, Nate, you've gotten a lot of those questions about moving out of, right, where they're working. And I think ultimately, that's something that, is a very key piece about a determination of saying, if I'm in California or if I'm in New York, right, and I want to move out of state, how does that affect my equity? The answer there is, where were you when the shares were vested? Okay. I'm going to leave it there because there's so many complications, but the idea is, where were you when you actually earned the income? Where was it vested, right? Where was it determined as something that, like, you were part of that state, and that's the income you earned as part of that state? Because guess what? For the RSU example, if you worked 3 years in California and then you moved out of state, but you vested for 3 years in California, even though the tax was in the 4th year and you were not in this state, California is still going to be like, hey, you were here for 3 years, you worked here, you vested them here, so that is still a tax liable to California. I'm just pre-warning you right now, right? From an options perspective, same thing, right? If you haven't exercised the shares and it was vested while you worked in another state, guess what? You still have tax liable to that state. Now, it doesn't mean that they're going to double count the taxes. I'm just talking about it as you're still owing some other state taxes. They'll even it out in terms of who owes who, right, on your tax return. But still, you probably still end up owing the higher tax rate here, right? So just remember that, okay? Now, we are coming up on time, so there's a couple more items that Nathan wants to cover here. So Nate, what is it? What is it that you want to end with and telling, right, the employees to be very aware of?
Yeah, so a couple of things that you might experience post IPO that maybe are a little bit different than what you were used to when your company was private. So if you are exercising your options during the private company era, you're probably used to putting up cash to exercise your options,
Yes.
especially if you're planning on selling to secondary market or something like that, right? So you have to put up the cash to exercise. A lot of times they may also put cash requirements on tax withholding for you. Something that you'll have access to once your company is public is cashless exercise, and this is obviously going in parallel with a sell. So if your company uses, most commonly, like E-Trade is a really popular platform. E-Trade is saying, hey, I'm willing to give your employees the ability to not front the cash for this transaction, knowing that within a second, they're then going to sell the options as shares.
Yep.
So basically they would say, okay, great. You can go in, you can exercise, and immediately we'll just front load that cash for you for like a millisecond, knowing that we're going to immediately turn around and sell it to a buyer. So cashless exercise is something that you might want to familiarize yourself with. On top of this like 6-month lockout window that we've also mentioned to you, as an employee going forward, every company is different as well, and they have different tiers of what employees are subject and which ones are not. You might have trading windows, meaning like, hey, you can't trade around earnings date, but right after earnings, you would have a window of 3-4 weeks for you to be able to sell. So once you're past that 6 months, doesn't mean you'll always be free to sell if you
That's
continue
right.
to work at that company. So be aware they might have some trading windows. The last one I want to end with is kind of dirty for us to wait all the way until 50 minutes into the video, but it's the Biden tax plan. We have to mention it.
We
So
do. We do.
everyone's going to have a different windfall potentially with an IPO. But as it's written right now, who knows if it will pass? If it passes, if you make more than $1 million in a tax year, your capital gains tax rate will be 39%. They're no longer giving you that preferential long-term capital gains tax treatment. It will basically be at the highest ordinary income tax bracket, which will be 39.6%. I know you and Raymond have already tackled some of that. You did a specific webinar just on the Biden tax plan, but a lot of the strategy is moot if you're in that particular bracket and you can't even benefit from long-term capital gains. So sorry to wait so long into the video, but it has to be mentioned.
Absolutely. And then it's up. I mean, I'll give you my opinion on it, which is I think, we're still planning with a lot of our clients as if it's not going to happen because for now, right, we are aware that it's going to happen. But if, the plan was to exercise and hold, right, like we still want to have that time horizon and we still are putting these strategies in place. And ultimately, if it changes, the clients will understand, right? Hey, you know what? It didn't work out in our favor. But you're absolutely right. Like it could throw all these strategies that we're talking about right out the window if there's not any benefit. But again, it varies, right? Because the percentage of people that it's affecting is quite small in terms of it being above $1 million. Once you're below $1 million of income, there's still potential capital gains in this proposed plan if it passes, right? And so to your point, it definitely varies, right? Depending on the windfall, right, that you are going to receive.
To make it more complicated, it can also change next administration.
Absolutely, right? What if I just hold it for 4 more years, right? Or
Right.
2 more years or whatever, 3 more years, and then they change it again, right? And so those are all different types of things that you just have to be aware of as hopefully, right, we've taught you as part of this show, Dfi-nancial Friday is being aware and educate yourself as part of making, right, or decision making, okay? All right, so to close off, we've covered a lot, but if you're here and you heard about all of these things and it's still not clear to you, right? It is time, right, for you to seek out a professional, seek out somebody to understand your specific situation because we were just trying to talk generally so that now you're asking these questions, okay? If you're here and you wanted to talk about early exercising or 83B election or QSBS, like what did you just say, Alfred? Yeah, I know. Like it's just things that are more of an advanced equity compensation topics that look we can't cover because it's so specific to certain people. But if that's you, reach out to us, reach out to a professional to talk about that, right? And I will tell you, right, the financial planning world, Nate, I think is realizing that like equity compensation is a big part of maybe hopefully not just Silicon Valley, but like, across the US, you have a lot of income being made this way. So if you're going to go out and seek a planner, make sure they understand equity compensation because if they don't, I don't know that they're going to be as helpful as you would want them to be. Okay. So there's definitely that kind of specific niche that you guys should be looking for, especially if this is the type of income and compensation that you're dealing with. Okay. All right. I feel like I need some water. Need to go sit down, right? It's Friday. Gonna go grab a drink. Cause that, I mean, hopefully for you guys,
We
it's a
could
great
talk 4 or
webinar.
5 hours on this. I mean, it's such
Oh,
a dense topic.
absolutely, we could. I mean, we probably do talk 4 to 5 hours a day about this as it stands, right? But again, thank you guys for joining us. Thank you, Nate, for being here. It's nice having you. to be able to refresh this topic that, again, was probably our most viewed video last year about IPOs, and rightfully so with all the activity that's been going on. If you guys find this helpful, comment below, drop us a like, right? Reach out to us, right? Let us know what you would like to hear more about in this topic, right? We'll be happy to share more with you. All right. I think that's it. We're going to end our show here. We'll come back to you live again next Friday at 3 p.m. for Dfi-nancial Friday. Nate, thank you for joining us. We'll talk to you soon. Okay.
Fantastic.